Hi, this is Randy Katz with Synesis Advisors. We've discussed in the last few episodes how buyers use the market approach to valuing businesses. And we're going to switch gears now and start talking about things that might cause your business to be discounted relative to the market. The idea, of course, being that as we start removing and fixing these issues, we're going to start seeing the value of your company increase. We're going to spend the next few weeks talking about the number one culprit that I see because it's so prolific and there's lots to talk about. That, of course, is the cleanliness of your financials. The financials tell a story about your business, and the better story they tell, the more confidence they can give a buyer. But if that story's rocky, it can create real or perceived risk. But either way, more risk in the mind of a buyer, of course, means lower price. So the first thing we're going to talk about today is the categorization of your expenses. Well-kept financials keep expenses in the same category year after year. But your office manager turned bookkeeper may not have a handle on things. All too often, I see expenses moved from cost of goods into operating expenses and back again. I see new categories showing up in a chart of accounts. I see line items showing up by themselves one year and later being consolidated into another line item. Then there's the dreaded negative expense, or worse yet, the ask my accountant line item. Buyers want to understand the margin structure of the business and be able to get a handle around all of your fixed costs and variable costs. From an advisor's standpoint, this will also help us identify one-time costs. If there's a positive change, it would allow us to identify and highlight. For negative changes, we can identify them and get out in front of the problems before they become big surprises and hurt you later. The other topic we're going to hit today are owners' personal expenses that are run through the business. If you pay taxes at 40% for federal and state, that might very well save you 40 cents for every dollar you put through the business. But if the business should sell for a 5-time EBITDA multiple, you lose $5 for every 40 cents you gain. Now perhaps the buyer will give you credit for the personal expenses, or maybe they'll ask themselves, if the owner's willing to play in the gray area when it benefits them financially, and I'm about to enter into a transaction that will benefit them financially, what else is going on under the hood? Keep a couple of things in mind. Buyers and banks are looking at typically 3 to 5 years of financials. So these aren't things that you can just fix right before selling your business. They have to be implemented well in advance of a deal. We're going to talk more about financial issues over the next couple episodes, so we'll see you again soon.